Hello and welcome to a fresh and brand new series where we are going to essentially talk about trader models or price action models. Now, the plan for this playlist is that we're gonna do two videos per model. So the first video would be an introduction to the model, and then the second video would be a protocol for the model. Now, remember when we talk about price action model, we're not talking about an overall trading model. We're talking about specific entry patterns, which should align with your checklist, which you should already have. As a trader, of course, you should have your pre-market checklist, your confirmation checklist, and all of that. Now, for each of the lesson, especially on the second video, we're going to talk about entry confirmations, when a trade becomes invalidated, when to go back in for possibly a re-entry, trade management protocols, target objectives, stop run levels. That would be for the second video, but the first video would be an introduction. Usually the first video is going to be short and sweet, and then the second videos would be a little bit more longer. So video one could probably be like a 5 to 10 minute video, and video two could be like a 1 hour video where we essentially do a breakdown of the model with actual price action itself, and then we use price action itself to kind of like reinforce the concept. And then this can be like a backlog that you guys can come and refer to for whatever trade confirmations you're looking for. So today we're going to look at the New York price action model, and the objective for this lesson is to introduce the series, which is what I've just done. We already know the setup for each of the consequent videos, so 2 videos per model. First video is going to be an introduction, second video is going to be the breakdown of trade management protocols, confirmation protocols, entry protocols, and whatnot. And we're also going to do an overview of the trading model, right? So the trading model we're actually looking at for today is the New York AMD model. This is the New York intraday AMD model. So AMD stands for accumulation, manipulation, and distribution. Now, there are key specific criteria for our trading model, which we are going to discuss. Now, what you can see here with this chart is you can see I have labeled individual components of the chart, right? You can see there's number 1 and 2 and 3 and 4 and 5 and 6. And the reason why this is labeled is because it will be essential for what I will talk about next in terms of understanding the different properties of each aspect of our model. So the goal, and this is why I'm redoing the whole playlist series, unlike the previous one, the goal is to be more refined, more defined, and have strict rules and engagement protocols for each trading model. So the first one, of course, is the New York intraday AMD model. Now, this is not your classic expansion and offset accumulation model and continuation profile. This is actually quite different because this is more time specific. Now, even though this is not on my drawing, on my chart, we will talk about each segment of the model. Now, the reason why this is more time specific is because this is more centered around New York session, mainly New York session, and maybe sometimes London close, right? Again, it all depends on the economic calendar, which we're going to address on the second video, right? But we are primarily focused on New York session and London close as our window of opportunity. Now, the premise of the model is based off of 2 things, right? So you can easily pre-anticipate the model potentially forming and knowing exactly what to do, right? You know exactly what to do once you see certain characteristics. So the first characteristic for a model is the overextension during Asian session. So usually during Asian session, the market is delivering in direction of item from order flow. And a lot of times, typically we don't like to see Asian session be overextended, right? So out of the 3 or 4 major sessions, so we can see Asian session, London session, New York session, and also London close session. In terms of volatility, we will typically see the most amount of volatility during London session, followed by New York session, and then London close, and then Asian session. So Asian session typically is more of a consolidation profile. And, of course, going to London session, that's where you get your classic manipulation play, and then the market reverses and goes in direction of item from order flow. But in this example, Asian session is overextended. Now, whenever we see overextension during Asian session, typically I like to tell traders that going into trade New York session, I'm not New York session, going to trade London session would be super low probability, right? So you can go and trade London session when Asian session is overextended, because the possibilities of a continuation after overextension during Asian session is lower. So typically we like to build on a London session and wait until New York session, right? So when we have that overextension during Asian session, so when we're up in the morning and we're looking at price action, we've done our thesis, we're averaging on liquidity, direction, levels that we're looking for the market to expand from or into, right? So if we and this would be a part of the model checklist, right? So we study properties during Asian session. We also study price behaviors during a London session. And then that would kind of like give us insights as to what New York session actually wants to do. Now, what you can see here with this diagram here is you can see that we have that high here, and then the market runs lower like this during Asian session. This leg here, that is the overextended price move. This is what creates that seek and destroy profile for London session. So typically when you have that overextension during Asian session, London session goes into a chop, 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 chop. Now, when we see overextension during Asian session, except we're trading against the direction during Asian session, right? We typically do not like to go in and trade during London session, a continuation trade. Now, there are clear exceptions to this, which I will fully discuss on a separate lesson for trading London session when this problem or situation does present. But typically when we have overextension during Asian session, we build on London session, and the same thing also applies for trading New York session, right? So if we see a really overextended move during London session, we build on New York session. We skip New York session and focus instead on London close session, right? So you can see the difference here. So it's all about understanding overextensions, because, and here's the main point with overextensions in price. With overextensions in price, what you're trying to do is you're trying to determine when the market is most likely to see the most amount of volatility. Now, with overextensions in price, typically what you get is there is restrictions on how much of a point that assets can move, especially assets involving traditional markets. So traditional assets, classic assets would be your typical commodities and currencies and stuff, right? These are markets that are more liquid, right? And we like to call them traditional asset classes. There are restrictions as to how much of a point or move that they can make, right? So when we're looking at, especially when it comes to currencies, we know that we're not freaking getting a 1,000 pip move in currencies. We're not getting a 2,000 pip move or 500 pip move per day on currencies, especially on the majors. Right? We know that is not happening. Right? So when we see significant expansion during one session, that leads to an overextension in the direction of our general liquidity. We don't want to go into the next session because the likelihood of the market just continuing in one direction would be so low. Think about how many times you get 100 plus pip rally or decline on any of the major currencies. It is so few and far between. And the reason why is because a typical move, you're not getting 100 pips in terms of a typical move. So you're trying to optimize when you are more than likely to get a volatility, right? So the first characteristic or property we'll look for our New York intraday AMD model is overextension during Asian session, seeking the sharp profile during London session, going into London long session, and then initial jitter swing during New York session that oftentimes coincides with the economic calendar, right? So typically around economic release, the market would either make the top for this bearish example, or if we're still trading down here inside the consolidation profile, then the news should be used to drive the market up into our premium rate to then go and look for our shorts along with our trade confirmation profiles. And then this would be another level where we can pyramid trade, right? You can add more pyramids at this level here. And what you're targeting is you're targeting external range sell-side liquidity pool. Now, if you look at this overall diagram a little bit more, you can see what I've done here is I've broken down each leg into external dealer range and internal dealer range. Your external dealer range is that initial overextension where you see that one-sided move that creates a lot of inefficiencies typically, and all of the subsequent consolidation will trade inside of the high of that daily range and the low of the daily range becomes our external range liquidity, right? So we can see here is our external range liquidity in form of buy side liquidity and external range liquidity in form of sell side liquidity. Now, we only target liquidity on either side depending on our draw on liquidity on the daily time frame, which is why daily time frame is a key component to our analysis. If daily time frame profile is bearish and we're looking for draw on liquidity lower, we're looking for sell side. If daily time frame profile is bullish and we're looking for draw on liquidity higher, then of course we're looking for buy side liquidity, right? So again, the one thing I want you to fully understand with this kind of model is I don't want you to expect this model to form every single day, right? Which is why there's going to be multiple models, right? This is not a kind of model that forms every single day. This is a kind of model that forms once in a while. If this is something that fits your personality profile, then this would be something you have to back test and get data on, right? So you need to have data on any of the models I am sharing with you, right? You need to have data on them. You need to do your own back testing sessions and have data on them. Now, the reason why I personally cannot do them is because a lot of my data are lost in my old journals or notes, and essentially it's going to take a lot of work for me to get a proper sample size to organize data for on this. So the option is to either wait for me to do all of that, or you can do it yourself, right? So you have two options here. But I would definitely be doing it myself, back data, strategy tester, and I would actually test with the live account to each of the trainer models, which would take a lot of time. So we would see how we can speed up the entire process, especially for new members, right? People are going to come in the future and they would be, of course, watching a video like this. But the entire premise here is that we are looking at that market driving up into that premium, and the whole narrative for the AMD model simply is a play on weak liquidity. Now, when the market is trending in one direction, when the market is moving in one direction, maybe the market is moving up or the market is moving down, there's always going to be vested interest from market participants to want to align themselves with the direction of price. Whenever there's any form of significant displacement on the lower time frame, there is a lot of interest from market participants wanting to do transactions in direction of that displacement. This creates what we call weak longs and shorts in the marketplace. So essentially, as the market trades lower, shorts will enter into the marketplace out of excitement. This is what we call FOMO. FOMO is essentially the fear of missing out. This is a situation in which the market is moving and people feel like they need to get a piece of the pie, and they end up chasing the move, chasing price, only for them to get stopped out, and then the market still moves in their direction. So this is a model designed for that, right? So essentially what we get here is we get that initial displacement during Asian session, right? So traders during London session, they're waking up and they're looking at the market and they've seen a massive drop. Sure, it is in direction of buying from order flow, but they've seen a massive drop in terms of price delivery. What do you think you're thinking going to London session? Let me try and get the continuation of the move. Let me try and align myself with this massive sell and try and capture just a piece of the pie. Let me get something out of price action. And this typically is how the whole trap starts. Because now what actually happens is they go in wanting to do their transactions, wanting to align themselves with price, and they're stuck in a trade. Think about how many times you took a trade during London session and the market was just stuck and slow and you were just so frustrated because you're like, why did I take this trade? And you have to wait and pray because the market is so close to your stop loss. So now you're waiting and praying going to New York session that you're not stopped out before the market actually moves in your direction. Think about how many times that has happened. Now, what I want you to do here is, in some of those instances, you are more than likely during London session after an overextension during Asian session. I'm not saying this is all the cases because there are different scenarios in which we can get a stick in the short profile for London session, but this is one of those probabilities, one of those possibilities. And this is also one of the most important or major ones, which is when we have overextension during Asian session, then a lot of times London session would tend to consolidate, and then New York session would tend to continue the move from Asian session. So this is the AMD model where we have our accumulation, and the accumulation phase starts typically during London session after overextension during the Asian session. And then going into New York session, there's a trigger, and usually the trigger is preceded with a stop run, right? Usually a stop run against our direction. So if we're looking to be short on an asset class, typically before that manipulation against internal dealer range liquidity, there is usually a small structure, what looks like a market shift. This typically gets traders who want to align themselves with the short. It gets them more excited to want to chase the shorts. And then what does the market do? The market puts the brakes in them, either at the news or just before the news. The market runs aggressively. It looks like the market is running aggressively. So all of the shorts inside this range, they're underwater, right? Because now the market is going for them. The market is going for their stops. And then what happens? Only for the market to shut up into a premium array, we're going to talk about characteristics of this order block or fair value gap. Only for the market to shut up into that and then just still end up selling off, right? So we can look at an actual example on DXY from, this was Wednesday, 2 days ago. Not 2 days ago, last week. I said 2 days ago. So this was from Wednesday last week. Now, if I just go down to an M15 time frame, just so we can see the picture clearer. So we're gonna delineate Asian session here. So this is the start of Asian session. End of Asian session. Start of London session. End of London session. Start of New York session. End of New York session. Okay, so now what you can see here is going into the Asian session, you can see the market just opens and then just starts to drop. It drops really, really aggressively. Now, what do you think traders are thinking going into New York session? So let's use a replay tool like this. So now this is Asian session done. Imagine you're a trader, right? You wake up during an Asian session. Oh, well, the market has sold off like this. We have support level here, or what institutional traders like us would say, clean lows down here. So it makes a lot of sense for the market to want to trade down there and tag the sell side liquidity, right? So the market should go and take out the sell side liquidity. So going into London session, what are you thinking? You're thinking, let me go and continue the shorts. Let me maybe go and continue the shorts from this bearish order block or inefficiency. That is if you're trading institutional. If you don't trade institutional, then you're probably thinking to yourself, okay, well, I can go and short some kind of like premium, some trend line confirmation, some kind of something, and then go into London session. Now think about what is going on. What do you think is going on here? If you did not go and take your sells, you're probably pissed off. I missed out on the sells. Ah, fuck. You're probably taking the sells. And if you shorted inside this range, you're probably excited. I'm smart. I'm a genius. I'm gonna make a lot of money, right? Because we're seeing displacement lower, right? Displacement lower from into my general liquidity. So I am going to make a lot of money because now we're seeing DXY go lower. But you can see during Asian session we had a massive expansion lower. Now this is not necessarily super massive, right? But this is an expansion lower. This is a significant price where we don't like to see this kind of price like is what we typically would get during New York session or London session on DXY. Okay, remember this is not a cross pair, right? So you don't expect 1,000 pips lower. So this is DXY, right? This is a significant move for DXY. So we've seen dollar drop like this and then go into London session, market starting to go lower. But now watch this. This is the main component here. Can you see how sluggish price is trading lower? So let's go on the lower time frame and then just see what the narrative looks like on the lower time frame. So this is an M5 time frame. right? So you can see here during London session, we open and then the market starts to drop initially, and then we trade back up into inefficiency and volume balance. The market sells off, returns back up into propulsion block, sells off, returns back up into volume balance, sells off. If we are in a trade, we like to see one-sidedness. This is not one-sidedness. That is not, sure, the market is going lower. That's not one-sided. This is one-sided. Stop print, breaks lower, break a block. Does not want to waste time. Sells off. Fair value gap. Trades lower. Propulsion block. Sells off. Fair value gap. Sells off. Can you see how smooth, how responsive it is compared to what you can see here? Even though it does sell off, but every time it sells off, it wants to return back up into premium. That's not a signature for a high probability market profile. So now what you get, all of this is just seeing these weak shorts into the marketplace. People are trying to chase the move lower, right? Prices inducing them into the marketplace. So what are they doing? You're going in just on a short. Every time the market breaks structure lower, even though the market is not really going anywhere. If you look at this, if you actually study this price move, market is not really going anywhere, right? But it's just going. It looks like the market is going lower and lower and lower, and it is all psychological. This is why in what we do, one of the most essential skills that you can ever learn is patience, ability to not act when you have told yourself you're not going to act, because it is so easy. I could teach you the model, but in real time, when you're looking at price action, it is so easy to convince yourself there is a trade in this. The market is going lower. I want to see lower prices, and the market is going lower. So there's a trade in this. I'm gonna go in and take that trade, and then you get stuck. Now you're stuck just like everyone else, and that breaks our number one principle of how we approach, what we do, how we approach trading or investing. We don't want to buy when everyone else is buying. We don't want to trade when everyone else is trading. We want to sell when everyone else is looking to participate in the move. That's the way you go. So looking at all of this just slow drivel lower, sure, the market is breaking structure lower, but all of this is all psychological, because now what this is doing here is it is giving a false sense of security to retail, who are thinking that they are aligned with order flow, and they are of course going to see a lot of the market is going to sell off. You're going to make a lot of money, and this is probably where a lot of people start thinking about your profits, what they can do with your profits, the money that's going to come in. I could do this with my money, I could do that and whatever. And as we go into London launch, you can see the market makes a low like this, clean lows down here. Go into London launch. Of course, London launch, we don't expect a lot from price, right? So we're essentially waiting just until before New York session. Now look what's going on. The whole of London session opens here, closes here, right? Not much of a difference, just like I talked about. And then go into London launch, the market starts to go higher. So now the main question is, where did we see the initial displacement from? Of course, it was from this lot here during Asian session. So now we understand the profile. How do we understand the profile? London session was not an expansion. London session was a consolidation profile or seeking the short profile. If you bought during London session, you've lost money. If you sold during London session, London launch is fucking you up. So that is a consolidation profile. Now, going into New York session and the start of New York session, watch what happens. Going back to the model, there usually is a trigger against the intended direction that then tricks people to think that the market wants to go in their direction. So imagine if you're short, because if you're going long in price, you're not making any money inside of this range. You're not making any money if you're going long. You've lost money. So the only participants in this price action are the shorts. Shorts are the only participants in this price action. So now watch this. Just before the market runs internal range liquidity, into a range bias liquidity, where all of the weaker shorts will protect their short position from or at. The market runs lower, and it looks like, again, this is New York Open. It looks like we're very, very bearish. Structure break. We expect to retest, we want to see the market sell off because we have the structure break. So now we're confident that, price is going to sell off. We have the structure break, Let's see what the market does. That is a New York Open, right? So a New York Open, the market starts to run aggressively higher. What do you think is going on here? If you're short inside this range, you're done for. Now you're probably thinking about revenge trading. You're probably thinking about flipping and going long. Maybe you were wrong, and you can't really understand why you were wrong in your thesis, and you want to revenge trade because your ego is hurt. So you go in and you flip, and you're saying to yourself, you know what? I'm gonna go long, right? I was wrong before. The market is obviously bullish, so I'm gonna convince myself of some kind of general liquidity on buy side, and I'm gonna go and take the trade. When all the market was doing was the market was just simply going back to an old level where we saw the one-sided expansion from. So now this is where I segue a little bit into each of the characteristics of our model, right? So now the first one, of course, is the high. And for this lesson, I am using a bearish example. So you just simply invert that for a bullish example. Now, in this model, the first part of the model is the high that creates the initiating swing. This is what I call the initiating swing. All right, so that expansion during Asian session, that is what we know as the initiating swing, initiating price swing. It initiates the leg lower. Now, let's talk about the characteristics of the high that creates that initial or initiating swing. All right, so first off, that short-term high usually is formed during Asian session. So during Asian session, typically is where you get the high and the displacement. Now, sometimes the high could form late New York session or London close session the previous day. Right? Sometimes that could form late New York session or London close session the previous day. So that is something, right? So the major portion of this here is the timing and the narrative leading up to the high being formed on the lower time frame. So now, in terms of narrative, this high has to be a continuation of a high of the week. So that means if the high of the week formed the previous day, that is your highest probability, because typically this trade during Asian session would be a continuation of that longer term swing being formed. It's just like the profile where we want to go in and trade on Monday, right? So if we want to go in and trade on Monday, the only time we go in and trade on Monday is when we expect a lot of volatility. And the only time we expect a lot of volatility is if the previous week, Thursday or Friday, the market makes a short-term high or low in the ratio of high time from order flow without a significant expansion yet. So we typically expect that Monday complete that expansion profile or continues the expansion profile. That is the same thought process with the high during Asian session that creates our initiating swing. We want to see the build up on the lower time frame. So the day before, especially, we want to see that day before we had the high of the week being formed. And not only that, but this high either has to be a continuation of a daily swing being formed, or it has to be the next daily candle after we've seen a daily swing high or low. So I'm giving you really specific instances when to expect this kind of profile. So this is something you probably have to replay a little bit, sometimes, so you fully understand what I'm saying, because I'm reading off of my journal, and it's not written on my screen because I want this to be free flowing, but you have to take notes on this. Okay, so we're gonna go to the next part, which is the initiating swing. So this massive expansion is what we know as the initiating swing. All right, so what are the characteristics of the initiating swing, right? So the initiating swing is time specific. It is focused, or it is strictly Asian session based. We don't care about any other sessions. We don't care about New York session, whatever. This is Asian session. So a part of our pre-market checklist, especially for London session and also New York session, is what we know as our Asian session assessment or Asian session thesis. What did the market do during Asian session? That would give you insight as to what the potential delivery profile should look like for London session, and also should look like for New York session, right? So the initiating swing, this should strictly form during Asian session. This is time specific, and we're looking for overextension. We're not looking for small moves during Asian session. We're only looking for overextended Asian sessions. Once we identify overextended Asian sessions, then we potentially have our intraday AMD model being formed. Now we're gonna go to the next one, which is number 3, which is what you can see here. Now, typically when price respect a premium or a discount array, we assume that markets are low probability and potentially consolidating. So we look for this characteristic in our pre-market routine before New York Open. So one of the main theses of this kind of play in price action is when price runs a pool of liquidity, right? So if we're looking for shorts and the market runs a short MI, we expect immediate feedback in price. Feedback in form of a bearish expansion, right? Because that means that we have trapped shorts. The most explosive moves usually occur after a run on counterparty liquidity, counterparty stops. Now, if we're in a market where we run stops like this, right? So typically if we're bearish and the market goes above a high like this, what you expect? You expect follow through. Now, what you don't want to see is back and forth. Okay? If we run a level of stop, if you look at this, for example, going into London session, that 1 hour period, we ran the short-term buys of liquidity. And then, of course, going into London session, the market just starts to make lower swings, right? A lower swing guy, trades back up into volume balance, sells off like this, trades back up into volume balance, sells off. But the one thing I want you to notice here is how lethargic price is. It's not excited to want to move. It's not seeing one-sided displacement. It's not creating a lot of inefficiencies, and immediately responded with strong bearish expansion. Now, look at this. Like, compare this price delivery to this price delivery. You can see every time the market wants to show up into a premium, it wants to respond with bearish sponsorship. But over here, we're not doing the same thing. Now, what I want you to do here is compare what we see during London session to what we see during New York session after we have the stop run. Right, so you can see here, if I can use your replay tool, after we have the stop run during New York session, watch this. Bearish order block, trades up into this. What is this? Propulsion block. Look at the massive displacement. Going into London close session, what else is going on? We have bearish fair value gap up here. The market trades up into bearish fair value gap. What are we looking for? We're looking for immediate expansion. This is what we want to see for high probability market profile. So one of the characteristics of this London session profile is the lack of follow through. It is absolutely necessary. So the way I like to put it is this, right? Because there's no real way to measure what is the lack of follow through. So what I like to use as an analogy is, I just lost my train of thought there for a sec. Willingness, right? This is what I call general asset willingness. If I want to see sales, I need movement. I want to see the market move. I don't want to see the market chop around, because if the market is chopping around, then more than likely price is either holding for a new session or there's about to be a manipulation going on, especially if you're day trading, right? So you can see here the market chops around. As soon as we have that run up into premium array, what does the market do? Starts to be one-sided, right? So that is one of the characteristics of this profile, where there is a lack of follow through every time the market breaks a low. So you can see every time we run below the sell side liquidity here, it wants to return back up into a premium. It does not want to continue lower. It does not want to reference new liquidity for transaction purposes. You can see here, whenever we break sell side, it wants to immediately displace away from there and seek new levels of liquidity. But then compare that to London session, whenever we break sell side liquidity, the market wants to look at this here. We have sell side liquidity down here. The market breaks that, wants to return back up there. Okay, we would expect that. Okay, price is returning back up here, and we should see follow through in terms of downside. We are starting to see follow through in terms of downside, and then what does the market do next? Returns back up there. You can tell how frustrating this is, right? So and the number 4 is the trigger I talked about. Typically, that can be initiated by news. Now, this was on a day where it was a government shutdown, so no data released, or no data was released on DXY, so no news for the whole day in dollar, right? But again, it still forms during our active session, which is essentially New York session. What you can see here is session open, the market starts to run higher. This is our jitter swing, even though this was really, really late into New York session, but session open, market runs higher. And then what happens next? Runs higher to our key level and then starts to sell off from there, right? So again, we're going to do a lot more in-depth breakdown on how to select levels, right? How to select the appropriate level to trade from. But essentially, after we have the trigger, the market goes up into an external range order block or fair value gap. So when I say external range order block or fair value gap, that essentially means that a premium array that is external to this consolidation formed during London session. That's what we're looking for. All right, so that happens to be this inefficiency here, which just happens to coincide with a higher time frame level, which is also going to be a key component here. Most of your intraday levels would align with higher time frame key reference points. And then finally, you have your opportunity to retrade with your maybe fair value gap, or changes to the delivery, or propulsion block. It all depends. And then obviously you're targeting sell stops, right? So on the next video, we're going to talk a little bit more on actual protocols for how to go about execution, management of thesis, and all of that. So in the meantime, you guys trade safe, enjoy yourselves. Hopefully you enjoyed the first video, and then let's see if the second one can top this. In the meantime, trade safe.